Matt Orton is Chief Market Strategist at Carillon Tower Advisors, and Randall Kroszner is Deputy Dean, University of Chicago Booth School of Business, and former Federal Reserve Governor. Gentlemen, great to have both of you here. Thank you very much for joining us. Mr. Kroszner, if I can start with you, what was the interpretation for the market which was new from what Mr. Powell said? Was it the message that there is no pause coming anytime now, that rates will be higher for longer? Even if they pause, there is no cut. They'll stay high for longer. Is that the message? What was new?
So he had said that at the previous Fed meeting at the beginning of the month. He had said that he and his colleagues have been saying that over and over again since the Fed meeting, but the markets weren't believing it. And finally, when he gave a very short speech that was focused on one thing, which was we're going to be raising rates and then keeping them there until the job is done, as you heard him just say, the markets finally realized this guy's serious. They're going to keep rates up for probably most of 2023 rather than pivot sometime in early 23, which is what the markets had been expecting.
Okay. Randy Kroszner is also joining in on the show. Randy, good morning and thanks for joining in. What's your own view on how to expect, Matt Orton is also joining in on the show. I beg your pardon. Matt, good morning. What is your own view on what the Fed would do in September? There is an expectation that there would be a 75 basis points rate hike as well. Are you expecting that? And do you think it was any different from what the Fed chairman's statement was earlier? Because it didn't look like there was too much of a change, but the market still got spooked anyway.
Hey, Sonia, always great to see you. And I don't think we know exactly what's going to happen in September. And the Fed didn't really give anything away at this meeting, nor should they, because they have said that they're going to remain data dependent. And we have non-farm payrolls coming out on Friday. We're going to get CPI kind of in the middle of September. I believe it's on September 13th. So both of these data points are going to be important to guiding what the Fed is going to do. I actually think the Fed's probably going to go with 50 basis points because, again, overshadowed with Jackson Hole last week was the fact that we're continuing to see some of the inflation readings come down. Headline PCE, core PCE, both came down lower. You're still seeing some resiliency with the broader economy. So that's all encouraging. So I don't think they're going to need to go 75 basis points. But to your other point, nothing that Powell said on Friday was really a surprise. We've been telling our clients that the notion of this dovish pivot, the Fed maybe starting to lower rates in 2023 was really, really misguided, especially given how strong the economy is. And so we've been advocating to our clients to maintain a more defensive position and still try and use some of these pullbacks opportunistically, because I still think in the intermediate term, this market is going to go higher.
Okay, all right. Got that, Matt. Mr. Kroszner, coming back to you then, what are you factoring in for this September meeting? And also, some part of the stock market at least believed that maybe the Fed will go overboard in the near term and they'll be forced to pull back, in terms of the interest rates in 2023. Are you in that camp, or you believe, no, that rate cuts will not come about? Go ahead.
I really don't see that happening, although all of this is assuming no major geopolitical event. And of course, there are a lot of issues related to Mr. Putin. There are a lot of issues in Asia, a lot of issues in the Middle East. And so obviously there could be some sort of unexpected shock that comes in that could upend all of the forecasts. But putting that aside for the moment, the Fed is not about to turn around. Jay Powell talked about Paul Volcker and what Paul Volcker did. And so it wasn't by accident that he talked about the importance of making sure you get the job done. He talked about the mistake that was made in the late 1970s before Volcker came in to pull interest rates back down. As inflation came down just a little bit, then inflation exploded, and Volcker had to raise rates to double-digit levels. Remember, the last time that inflation was this high in the US, interest rates had to move to double-digit levels. I don't think they need to go there, but he was making it really clear that if we don't move aggressively now and then stay there to make sure that the job is done, as he said, make sure that rates stay high enough to ensure that the inflation rate comes down very close to their 2% goal, they could make the mistake of the 70s, have to raise rates really high and have a much, much more severe contraction or slowdown than we otherwise would have.
Right. Mr. Kroszner, I mean, at the end of the day, this is also about credibility for the Fed, right? I mean, they need to be seen to be credible. They have to be credible, and then they have to be perceived to be credible. So that's true everywhere. There is quantitative tightening as well, the pace of which doubles starting September. So far, markets have been pretty sanguine about it, okay? So far, there's been no great impact in markets. There's a bit of lack of clarity in terms of how the impact is going to go through into equity markets and other risk markets. Does that also come into sharp focus now with what we heard?
So I think the Fed likes to focus monetary policy on interest rates and have the balance sheet be either increasing or decreasing more in the background. And so you're exactly right. The pace of the reduction of the balance sheet size will step up as the fall comes. They're hoping that that's not going to cause any disruption to market liquidity, and so that can just going to go on in the background. But their main focus is going to be interest rates.
Matt, how does one approach global equities now? Because at least for a market like India, despite all the challenges, this market has climbed every wall of worry. We're not even 5-10% away from the all-time highs. Do you reckon that could be the case through the course of the year, that despite all the rate hikes, the market will continue to inch up higher, especially emerging markets like India?
I think, Sonia, is selectivity in what moves higher is going to be the most important thing. And last time we spoke, I was speaking about my optimism around India and Latin America, as well as U.S. equities in particular. And while I still favor U.S. equities just because of the diversity you get and the ability to lean into dividend growth and more growth at a reasonable price, I still believe that there's a lot of opportunities in Indian equities and Latin America, especially in industrials and financials. Those parts of the market have held up very, very well. Certainly on a pullback, I might be looking to add a little bit more exposure to both of those areas because they're a little bit insulated from what's happening in the rest of the world. Demand in emerging markets is remaining strong, and the emerging market complex overall is trading at the cheapest levels relative to the S&P 500 as it has in over 20 plus years. So, certainly emerging markets are poised for a bounce, but you need to be really, really selective in what you own. And even within India and Latin America, you need to be selective of what you're going to own as well. I think that's front and center, especially given the volatility that we're seeing right now. But I would certainly use this volatility opportunistically.
Okay, all right. Matt, just a quick clarification from the emerging market basket. Where does India rank? We're relatively more expensive. Point number one, if you could give us a sense on that. And also forget about all-time highs. The lowest that we made in June, do you believe that that will hold out for global equity markets?
So I think for U.S. equities and for some emerging markets, I do think that the lows we saw in June are probably going to hold. It's irresponsible to deal uncertainties, so I'm not going to say with 100% conviction that we have absolutely seen the lows, but I feel more and more confident that we have. In the U.S., you're seeing the advanced decline line hit new all-time highs. If anything, I'd say we might have a stealth bull market that's happening beneath the surface in the U.S. I would say in the Indian equity side too, it still screens favorably relative to other emerging markets. The price action relative to the EM complex and relative to even other outperforming countries looks very, very good. And while valuations might be relatively more expensive, that's not necessarily a bad thing given the growth characteristics that are embedded and the fact that the consumer is still doing well, the economy continues to reopen, and you're seeing earnings resiliency as well. So I like it. I'd say because of the valuation aspect, I'd put India number 2 on my list after Latin American equities because I still think there's room to run and you get favorable tailwinds with respect to commodities given the ongoing crisis in Russia and Ukraine.
Matt, absolutely sort of with you on growth and growth characteristics of the economy here, etc. The only pushback one gets is valuations. It's always been an expensive market, relatively speaking, India, that is. And right now, it's not very expensive, but it's not cheap either. Some 20 times 1 year forward earnings, right? So when you rank India at number 2 basis valuations, just wanted to clarify that. Are you saying it's cheap from a historical perspective?
I'm saying it's relatively more expensive. I like the growth characteristics, but relative to Latin America, I think it's that valuation aspect that moves it into the number 2 slot.
Fair enough. We leave it there. Gentlemen, thank you very much for joining us. Matt, great to have you with us here as always on CNBC. Mr. Kroszner, it's a pleasure, and hope to have you back again for more perspective. Thanks indeed.